and welcome to the Retirement Wealth Podcast. We're so glad you could join us today.
Absolutely, Emily. Today, we're diving into a topic that's really crucial for a lot of folks: retirement planning in your 50s.
Right. It's such a pivotal decade, isn't it? You know, so many people start to think seriously about their financial future in their 50s, and it can feel a bit overwhelming.
For sure. But it doesn't have to be. We're going to break it down. Talk about things like how to assess your retirement savings, the importance of catching up on contributions, and navigating healthcare costs.
Yes, and we'll also touch on some strategies for maximizing Social Security benefits, which is so important.
Exactly. It's all about making informed decisions now, so you can enjoy the retirement you've been dreaming of.
And we want to make sure you feel empowered, not stressed, about this process. So let's get started with our first point: how to evaluate where you stand financially as you approach retirement.
Sounds great. Let's jump right in. You know, Emily, when we talk about retirement planning in your 50s, it really can't be overstated how crucial this decade is. We're looking at a time frame where decisions made now can significantly impact the next 30 years of someone's life.
Absolutely. It's like the calm before the storm, right? People often think they have more time, but those years can fly by.
Exactly. I mean, if you're 50, you might only have a decade or so before you retire, and that's not a lot of time to set things in motion if you haven't already. I've seen clients come in, and they're just starting to think about these things, but the clock is ticking.
Right, and with all of the changes in the economy lately, it makes planning even more urgent. Inflation is a big concern.
Yes, inflation can eat away at your savings faster than you might expect. I had a client, let's call her Linda, who thought she was all set with her retirement savings. But with inflation creeping up, the purchasing power of her savings dwindled.
That's a tough reality check. It's like, you think you have enough, but then, bam, prices go up, and suddenly it's not what you thought.
Exactly, and it's not just consumer goods. Healthcare costs are skyrocketing too. I mean, even with Medicare, out-of-pocket expenses can be substantial.
Oh, definitely. I've read that many retirees underestimate those costs by quite a bit.
Right. I remember another couple, Tom and Sarah, who were shocked when they realized their medical expenses would be one of their largest monthly bills in retirement. They thought they'd planned well, but unexpected health issues made it clear they needed a better strategy.
That's a real eye-opener. And market volatility adds another layer of complexity.
Yes, it does. The stock market can be unpredictable, and if you're relying on your investments for income, a downturn can be devastating. I've had conversations with clients who were close to retirement and had to reconsider their plans when the market took a dip.
That's so stressful. It's like you think you're on the right track, and then suddenly, it feels like the ground is shifting beneath you.
It really can feel that way. And you know, with all this, it's important to think about tax efficiency too.
Oh yes, taxes can really sneak up on you in retirement.
Exactly. A client of mine, let's call him Mark, had a hefty chunk of his savings in traditional IRAs. He didn't realize just how much taxes would affect his withdrawals. When he started pulling money out, it was a rude awakening for him.
Wow, that's a tough situation to be in. So it's not just about having enough saved, but also how to withdraw it efficiently to minimize tax implications.
Spot on. And let's not forget about Social Security. The rules are changing, and it's important for people to understand their options.
Yes, many people don't know that the age at which they claim benefits can significantly affect their monthly income.
I've seen clients who thought they'd get a certain amount, but by claiming too early, they left a lot of money on the table.
It's really important to strategize around that.
And legacy planning, that's another piece of the puzzle. Many folks want to leave something behind for their children or grandchildren, but they often don't have a clear plan in place.
Right, and that ties back into emotional security too. It's not just about the money. It's about peace of mind.
Exactly. People want to know they're leaving a legacy, not just financially, but also in terms of values and lessons.
And that can create a sense of fulfillment in retirement.
Definitely. I think that's why it's so important to take a comprehensive approach to retirement planning in your 50s.
And with all the current economic trends, it feels even more crucial than ever.
Yes, and the emotional side of financial security can't be overlooked. I've seen how anxiety about money can affect someone's quality of life.
Absolutely, and if you're constantly worried about whether you'll have enough, it can really take a toll.
Right. I had a client who finally took a step back, created a solid plan, and I could literally see the relief wash over them.
That's such a powerful transformation.
It really is. It's not just about the numbers. It's about living the life you want in retirement. So when we think about all these factors, timelines, inflation, market volatility, taxes, healthcare,
And the emotional aspects too.
yes, it all builds a compelling case for why planning in your 50s is so critical.
And that brings us to the core strategies people can use to navigate all of this effectively.
So Emily, as we dive into retirement planning in your 50s, one of the core strategies I often recommend is really looking closely at your asset allocation.
Right, because by this point, people are starting to think about how to balance growth with preservation.
Exactly. Typically, a common rule of thumb is the 100 minus your age rule for stocks. So, if you're 55, you might want around 45% of your portfolio in stocks, and the rest in bonds and other safer investments.
That makes sense. So you're adjusting your risk level as you get closer to retirement, right?
Yes, and it's not just about stocks and bonds. You also want to consider tax-advantaged accounts like 401ks and IRAs.
Oh, for sure. Those can really help you maximize your savings without getting hit hard by taxes.
Right. If you're still working, contributing to your 401k is a great idea, especially if your employer matches your contributions. That's essentially free money.
Absolutely. And don't forget about IRAs. With a traditional IRA, you can potentially deduct contributions from your taxable income, which is a nice perk.
And for those who might be over 50, there's that catch-up contribution. You can put in an extra $1,000 into your IRA each year, or $6, $500 into a 401k.
So that can really add up if you're playing catch-up before retirement.
For sure. And let's not overlook Roth accounts. With a Roth IRA, you pay taxes now, but your withdrawals in retirement are tax-free.
That's a huge benefit, especially if you expect to be in a higher tax bracket later on.
Exactly. It's all about tax diversification. Having a mix of taxable, tax-deferred, and tax-free accounts can give you flexibility in retirement.
And speaking of flexibility, let's chat about Social Security. When's the best time to start claiming benefits?
Well, it really depends on your individual circumstances. If you claim at 62, you could see a reduction of up to 30% compared to your full retirement age benefits.
So waiting until your full retirement age, or even until age 70, can make a big difference in your monthly payment.
Absolutely. If you can afford to wait, it often pays off. Each year you delay, your benefit increases by about 8%. Until you hit 70.
That's a solid increment. And you can also consider the spousal benefits, right?
Yes. If one spouse has a much higher earning record, the lower earning spouse can claim benefits based on the higher earner's record, which can be a game changer.
Okay, let's switch gears a bit and talk about withdrawal strategies. I've heard a lot about the 4% rule.
The 4% rule is a classic guideline suggesting that if you withdraw 4% of your retirement savings annually, your money should last about 30 years.
So if you have $1 million portfolio, that means you'd withdraw $40,000 a year?
Exactly. But keep in mind, it's not a one-size-fits-all. Market conditions can affect how long your savings last, so you might need to adjust that percentage.
That's where the bucket strategy comes in, right?
Yes! The bucket strategy divides your assets into different buckets based on when you'll need the money.
So, like the first bucket for immediate needs may be in cash or short-term bonds, and then a second bucket for medium-term needs with some moderate risk, and then a long-term bucket with riskier investments.
Precisely. It helps reduce the risk of having to sell investments in a down market, which is really important.
I love that idea. It feels so much more structured and less stressful.
And don't forget about diversification. You want to spread your investments across various asset classes, stocks, bonds, real estate, to reduce risk.
Right, because if one sector takes a hit, others might hold steady or even grow.
Exactly. A well-diversified portfolio can help smooth out those bumps in the market.
And then there are tax savings techniques, right? Like tax loss harvesting.
Yes. Tax loss harvesting involves selling investments that are down to offset capital gains elsewhere, which can lower your taxable income.
That's a smart move for folks in their 50s who want to optimize their tax situation before retirement.
And don't forget about RMDs, or required minimum distributions, which kick in at age 72 for traditional IRAs and 401ks.
Oh, good point. You need to plan for those, as they can significantly impact your taxable income in retirement.
Yes, and strategic withdrawals can help manage that. Planning your withdrawals from different accounts can minimize your tax burden during those years.
So the key is to be proactive about all these elements, right?
Absolutely. Being proactive and having a solid plan in place can make all the difference in ensuring you have a comfortable retirement.
With all that said, it sounds like there are also some common pitfalls people should be aware of as they plan for retirement.
Definitely. It's easy to overlook things when you're focused on saving and investing. Let's dive into those pitfalls next. So, Emily, one of the biggest pitfalls I see in retirement planning is something called sequence of returns risk.
Right, I've heard of that. But can you explain it a bit more for our listeners?
Sure. Essentially, it's the risk that the market will perform poorly in the early years of retirement, right when you start withdrawing funds. If you're pulling money out during a downturn, it can really eat into your portfolio.
That makes sense. I can see how that would be stressful. Do you have any examples of folks who faced this?
Absolutely. I remember working with a couple, let's call them John and Lisa. They retired in 2007, just before the financial crisis hit. They had a solid nest egg, but they were withdrawing funds based on their initial projections.
And then the market crashed.
Exactly. Their investments took a hit, and because they were withdrawing money during that downturn, it significantly affected their portfolio for the rest of their retirement. They ended up needing to adjust their lifestyle because their funds ran out faster than they had anticipated.
Wow, that sounds tough. So what can people do to mitigate that risk?
A good strategy is to have a diversified portfolio with a mix of assets. Also consider using a cash reserve for the first few years of retirement. This way, you're not forced to sell investments at a loss during market downturns.
That's a proactive approach. What about taxes? I've heard that can be a big oversight too.
Yes, definitely. Many retirees underestimate the impact of taxes on their withdrawal strategy. For instance, if you're withdrawing from tax-deferred accounts, like a traditional IRA, you could end up in a higher tax bracket than you anticipated.
Oh, I can see how that could catch someone off guard.
Right? I had a client, let's call her Mary, who retired and started withdrawing from her IRA without considering the tax implications. She ended up owing a lot more than she expected when tax season rolled around, which forced her to adjust her withdrawal strategy dramatically.
That's a real eye-opener. So it's important to plan for taxes, not just the amount you need to live on.
Exactly. You want to strategize your withdrawals to minimize your tax burden. This could mean balancing withdrawals from taxable, tax-deferred, and tax-free accounts.
Got it. Now, what about healthcare? I imagine that's another area where retirees can underestimate their needs.
Oh, absolutely. Healthcare costs are one of the biggest surprises for retirees. Many people think Medicare will cover all their expenses, but it doesn't. For instance, I had a couple, Tom and Sarah, who thought they were well prepared, but they didn't factor in out-of-pocket expenses or long-term care.
That can really add up, can it?
Yes, it can. They had to dip into their retirement savings for unexpected medical bills, which really strain their budget. It's crucial to plan for those potential costs and consider long-term care insurance if it makes sense for you.
That's really useful information. What about longevity? I feel like people often underestimate how long they'll live.
That's another common mistake. With advances in healthcare, people are living longer, and that means your retirement savings need to last longer too. I had a client, let's call him Bill, who retired at 62, thinking he'd be fine for 20 years. But he lived to 90.
Wow, that's a long time.
He didn't plan for that length of retirement, and by the time he reached his late 70s, he was worried about running out of money. It's important to plan with longevity in mind, maybe even assuming a longer lifespan than you expect.
So what's the best way to prepare for that?
A good rule of thumb is to plan for a retirement that could last 30 years or more. That means adjusting your withdrawal rates and possibly working a few years longer if you can.
That's really helpful advice. Now let's talk about asset allocation. I've heard people can make some mistakes there too.
For sure. Many retirees become overly conservative with their investments, thinking they need to protect their principal at all costs. But if you don't have enough growth in your portfolio, you risk outliving your savings.
Right, it's a balancing act, isn't it?
Exactly. I had a client, let's call her Susan, who moved most of her investments into bonds because she was scared of the market. While bonds are safer, they typically don't provide the growth needed to keep up with inflation.
That's a tough position to be in. So how can someone avoid that mistake?
It's essential to have a balanced portfolio that includes a mix of stocks and bonds, even in retirement. Regularly reviewing and adjusting your asset allocation based on your needs and market conditions can really help.
That makes sense. And what about Social Security? I know people can claim it too early. How does that fit in?
Yes, claiming Social Security too early is a big mistake. If you take it at 62, you're locking in a lower monthly benefit. I had a client, let's call him Greg, who claimed early because he needed the cash flow, but he missed out on a lot of money over his lifetime.
That's a big deal. What should people consider when deciding when to claim?
Ideally, you want to weigh your current financial needs against the benefits of waiting. If you can delay claiming until your full retirement age or even age 70, you'll see a significant increase in your monthly benefit.
Such valuable insights, David. So if someone realizes they're making these kinds of mistakes, what's the best way to get back on track?
The first step is to do a thorough review of your financial plan. Identify where you might be falling short, whether it's in your asset allocation, tax strategy, or withdrawal plan. Consulting with a financial advisor can provide personalized guidance to help you make those necessary adjustments.
That sounds like a solid plan. It's all about being proactive and staying informed, right?
Exactly. The earlier you can identify potential pitfalls, the easier it is to make adjustments and ensure a more secure retirement.
Such great advice, David. I think our listeners will really appreciate these insights as they plan for their futures.
All right, Emily, let's dive into some actionable steps that our listeners can take right now, to really boost their retirement planning in their 50s.
Absolutely, David. It's all about making those small, manageable changes that can have a big impact over time.
Exactly. So the first thing I'd suggest is to start using some retirement calculators. Websites like Vanguard, Fidelity, and Schwab all have really user-friendly tools. You just plug in your numbers, and they can help you see if you're on track.
Right, and those calculators can give you insights into how much you might need to save each month, or even how to adjust your investment strategy based on your goals.
Yes, and while you're doing that, it's also a good idea to check out ssa.gov. You can create a My Social Security account there, which lets you review your earnings history and get an estimate of your future benefits.
That's a great point. Knowing what you might expect from Social Security can really help in planning your overall strategy.
And don't forget about tax software. If you haven't already, consider using something like TurboTax or H&R Block. They can help you understand how your retirement income will be taxed, which is crucial.
For sure. And if you're feeling a bit more tech savvy, there are some fantastic financial planning apps out there, like Personal Capital or Mint, that can help you track your spending and investments.
Those apps can be game changers, especially for visualizing your financial situation and setting goals. It's a good way to stay accountable, too.
Yeah, and speaking of accountability, let's talk about habits. One habit I think everyone should consider is reviewing their portfolio at least quarterly. It doesn't have to be a huge overhaul, just a little check-in to see if you're still aligned with your goals.
That's a wise practice. And running retirement projections regularly can help you see how different scenarios might impact your future. You can adjust your contributions based on those projections.
Exactly. And remember, it's never too late to improve your plan. Even if you're in your 50s, small adjustments can make a big difference over time.
Right, and if you're looking for additional resources, there are some great books out there like The Total Money Makeover by Dave Ramsey or How Much Can I Spend in Retirement by William Bengen. Those can provide deeper insights into planning.
I love those suggestions. And podcasts can also be a great way to learn while you're on the go. Shows like The Retirement Answer Man or Retirement Unplugged offer a wealth of information.
Definitely. Just immersing yourself in that content can really help you feel more confident about your decisions.
And it's all about taking those first steps. Maybe start by setting aside 30 minutes this week to review your financial situation or read a chapter from one of those books.
Yes, and don't hesitate to reach out to a financial advisor if you have questions or need personalized guidance. It can really help to have someone experienced in your corner.
Absolutely, David. Having that support can alleviate a lot of stress. So with these tools in your pocket, you're ready to strengthen your retirement plan.
And remember, it's all about progress, not perfection. Taking those small, actionable steps can lead you towards a more secure retirement.
Exactly. Now let's recap what we've covered today.
Well, Emily, as we wrap up this episode, it's clear there are some crucial points about retirement planning in your 50s that really stand out.
Absolutely, David. First off, we talked about the importance of maximizing contributions to retirement accounts, right? Those catch-up contributions can really make a difference.
Yes, and then there's the need to assess your retirement goals, like understanding what kind of lifestyle you want and how much you'll need to save to support that.
Right. And we also touched on the significance of creating a solid withdrawal strategy. It's not just about saving, but knowing how to draw from those savings responsibly.
And let's not forget the importance of risk management. As you approach retirement, you want to ensure your investments align with your risk tolerance and time horizon.
Exactly. It's all about building that balance, isn't it?
Yes, and, keeping an eye on healthcare costs and factoring those into your planning is crucial too. They can really impact your budget in retirement.
So many moving parts to consider. But the key takeaway is that it's never too late to start planning or adjusting your strategy.
Right. Building and protecting your retirement wealth is a journey, and even small steps can lead to big changes over time.
And if you found value in today's discussion, we'd love for you to like, subscribe, and share your biggest takeaway or a question in the comments. It helps us grow this community.
Definitely. And if you know someone who's planning for retirement or already in it, share this episode with them. They might find it helpful.
Next time, we're diving into something really exciting. How to replace your salary after retirement.
Yeah, that's going to be a great discussion. We'll explore strategies and options to ensure a smooth transition.
Thanks for joining us today.
Take care, everyone.
Bye for now.